Namaste, welcome to Arthaniti, where we discuss money and money matters to help you in your investing decisions. This week has seen stock market carnage. Yes, the Nifty has taken a significant tumble, going down by nearly 5% from its recent peak on the 13th of December. What has hit most is the Nifty Bank index. It has come down by nearly 3.4% this week to close at 50,729 mark. Now, what has caused this tumble in the Nifty Bank index? What are the reasons? What are the various factors behind this fall? How does the future hold for the banking stocks? Which stocks should you look out for from growth perspective in 2025? This is going to be the focus of today's video. So let's start. Before we start with the analysis, some fun fact. The Nifty Bank Index was launched on the 1st of January 2000 with the base value of 1000 points. So, in these 25 years, it has grown 50 times. This only reflects the remarkable expansion of the Indian banking industry. Coming to the analysis part, now the first reason for this downfall in the Nifty Bank Index is the hawkish stance of the US Federal Reserve. Last week, the US Federal Reserve's announcement has sent shock waves in the economic world. It announced a 25 basis point rate cut, but along with this rate cut, it signaled that for the next year, 2025, it foresees only two rate cuts. Now, this cautious approach of the US Federal Reserve has disappointed investors. It has resulted in strengthening of the US dollars, and which makes emerging markets like India less attractive for investments. The second reason is the massive FII exodus. Now, FIIs have been heading for exits right from October. In October alone, they offloaded a huge 1,14,000 crores worth of equity. They followed it up by another 42,000 crores in November. Now, in December, FIIs have actually been net buyers, totaling to 22,765, but on some days they have been big sellers, which indicates that they will turn to selling at higher levels given the high valuations of the Indian markets compared to other markets. The third reason is the high valuation concerns. Now, Nifty continues to trade at expensive valuations with its 1 year PE ratio nearing 20x. Compare it to the 10-year historical average of 18.9. So, it is trading above its historical average. Before we go on to the technical analysis, a fun fact again. Do you know that Nifty 50 comprises of a maximum of 12 stocks representing the most liquid and large Indian banking stocks? Now, this select group of banks forms the backbone of the India's financial system. Well, looking at the technical analysis, the Nifty Bank Index closed at 50,759 today. Now, it has breached several critical support levels. The next immediate support level is now at 50,300 to 50,500 as indicated by technical analysts. If it breaches the 50,300 level, it could slide further down to 50,000 mark. The Nifty Bank Index is well below its short term, that is 20-day, and medium term, that is 50-day moving average. Now, this indicates a bearish momentum in these stocks. Even though the Nifty Bank Index has shed nearly 2,000 points this week, any sustained trading above 51,000 to 51,200 mark is required to reverse this bearish stance in the Nifty Bank Index. A fun fact again, the Nifty Bank Index is calculated using a free float market capitalization method, ensuring that only tradable shares are considered in the index calculations. Let us look at some fundamental analysis. Firstly, credit growth. Now, loan demand is expected to improve, particularly for mortgages, as interest rates drop. It is expected that the RBI, in its next MPC meeting, will start the reduction cycle in the policy rates. Secondly, the asset quality, the quality of the loans that the banks give. Now, it is expected that this quality will normalize, but the banks could see some stress in consumer loans, especially in credit cards and auto loans. Thirdly, regarding the profitability, banks which have a diversified revenue stream are likely to have an advantage in 2025. So, look out for banks which have diversification in its revenue and they are expected to fare well in the next year. Despite this market mayhem, some banking stocks are showing resilience and promise. Let us look at some of these stocks and why analysts are bullish on these financial powerhouses. Firstly, SBI. It is the largest bank in the country with strong financial performance. It has a robust return on equity of 17.3%. The next bank to look out for is ICICI Bank. Digital initiatives by the bank are driving its growth, and its strong balance sheet positions itself for future growth. HDFC Bank, though it has faced some recent challenges given the merger, it has a strong franchise and growth prospects. Now, the management of the bank has said that cross-selling banking products to HDFC loan customers has significantly increased the asset book of the bank. And it has proven to be a good growth prospects for the future. Axis Bank, again, there is a target price set of nearly 1425 rupees by JM Financial, which implies a 22.5% upside. Now, the asset quality of this bank has been relatively steady in the second quarter of financial year 2025. Why do these banks stand out? Firstly, credit growth. Now, as it is expected that the interest rates would reduce, it would improve the loan demand and help these banks in improving their asset books. Secondly, asset quality. Now, asset quality is a very important indicator of the health or financial health of the bank. Now, with overall credit quality normalizing, these banks have shown resilience in managing their loan portfolios. Thirdly, diversification. Banks like ICICI Bank and HDFC Bank have varied revenue streams, so they are better off to weather any market storms. Fifth, digital transformation. ICICI Bank is the leader when it comes to technological adoption, enhancing customer experience and operational efficiencies. So, these are some of the reasons why these banks stand out and can be potentially good buys for 2025. Before we conclude this video, some fun facts again. As of September 2024, the top four private sector banks, ICICI Bank, HDFC Bank, Axis, and Kotak Mahindra, accounted for nearly 80% of the Nifty Private Bank Index weightage. Again, do you know that the Nifty Bank has given an impressive return over the years? From 2014 till 2024, it has delivered a CAGR of approximately 11.3%, outperforming many other sectors. So, to conclude this video, the recent performance of the Nifty might make you hide your money under the mattress. But remember, volatility often breeds opportunity. The banking sector, despite its challenges, shows some promising signs of growth and resilience. So, as we look forward to 2025, keep your eyes on stocks like SBI, ICICI Bank, HDFC Bank, Axis Bank, to name a few. Now, they are not just weathering the storm, they are learning to dance and make merry while it rains hard. So, in the world of investing, today's dip is tomorrow's peak. Now, stay informed, seek financial advice, and take decisions in line with your financial goals. That is the way to success in investing in the long run. So, if you have enjoyed this market roller coaster ride, please don't forget to hit the like button, share, and subscribe to our channel. Your support helps us bring you more financial insights. Until next time, stay safe, goodbye, and happy investing.